We're talking about potential distress in the future, potentially, but there's already some distress going on right now. We've already seen some pockets. We've already seen some early examples. In the Wall Street Journal this week, came out with a fascinating article. I mean, I saw it pop up, and I was like, I have to read this. It seems like it's relevant to what we do. And Matt, I don't know if the Wall Street Journal has taken their own magnifying glass and put it over kind of the multifamily syndication niche, which is a really a subset of the multifamily investment world and industry. That some of those that are in just that niche, it seems like that's the universe of multifamily investing. It's a much larger universe. But it's big and it's growing, and it's been driven by this idea that multifamily is an incredible wealth-generating tool, and the access point is real. The barriers to entry are relatively low in terms of experience. Any people from all walks of life can get involved in this by educating themselves, putting the team together. Well, but that doesn't necessarily mean that all the results are going to have the outcomes that the more experienced professionals often achieve. And I think that there is a feature specific to multifamily syndication in that the regulatory environment has changed since 2012. Which has really allowed a lot more people to enter in. And so it's a little bit of a young industry now. 11 years, not so bad for people to figure things out, but there's still some. And it's a crossroads. So you're right. It's at the crossroads of financial deregulation, the rise of just popularity of internet advertising, communicating, investing online, and advertising these investments online. As you said, Matt, back in 2012, we allowed for the possibility of like crowdfunding and offering different types of real estate if just alternative investments to the general public. And so we've seen that now over the last, it's just been a decade or so of that grow. And that's where we've seen the rise of these syndicators who are raising money, and us included in that. We've moved, we still work with individuals, we work with larger institutions now as well. But, your typical syndicator is raising capital from, call it business owners, doctors, lawyers, high net worth individuals, and anywhere from, $25,000 to $100,000 at a piece, pooling a bunch of money together, going out and buying an apartment deal. Yeah. So I'm going to skip to the bottom part of my notes before the first part. But I really think you helped really characterize, I think, this Wall Street Journal article really well. So yes, it does talk about loan distress, like we just talked about, 30 seconds ago. Yeah. It talks about a syndicator that was in the news that lost a lot of money at foreclose on 3,000 units of apartment properties, a significant amount. It was all over the news for multifamily insiders. Like a month ago, about a month ago. In April. We've mentioned it a couple times on the report, just as a data point, but we really haven't gotten into the full story. And this article from Wall Street Journal adds a lot more color because they actually talked to a lot of the investors involved, some of the lenders, a lot of people that are involved that really are close to the deal. And I wanted more. I was like, oh man, I could use another few pages of this. But so I'll just start where I can start. So 3,000 units. They bought these apartment properties when interest rates were really low. Put floating rate debt on it, and so that means when the interest rates go up, that loan is going to be more expensive to pay off, to service, what have you. And so he had to foreclose in April of this year. And those are 3,000 units of Sunbelt apartments. It really played into a lot of people, a lot of the narrative of this kind of rubber band effect. And investors lost everything. Yeah, everything. So it was a catastrophe. And it was almost this worst case, like this exemplar of what really could be in the offing. And so that's why I think it was paid a lot of attention to. Is like, wow, things could get this dramatic across the market. And in this case, it wasn't just that, they overpaid for the properties. They also neglected the properties as well. Oh, I did. In the article, it really goes into detail of how they basically just did not have a real good plan of managing these assets. Yeah. And it seemed like, this group had gotten just over their skis and took on a little too much too quickly. Yeah. They overpaid. I think they promised, I am highly confident they promised things that they could not deliver on. And reading between the lines in the article, I think that's how that is the total implication.
And they said, everyone, they had quotes from the syndicator being like, I never have to worry about basically economic cycles because everyone always needs a place to live.
Yeah.
And I hear that more and more these days. If like it doesn't, you ignore ignore all the numbers, ignore that we're going to be overpaying. It's just people need a place to live. Yeah, people need a place to live, but you can also overpay for something.
Yeah.
It's in demand. I mean, if like we all agree there's a limit.
So, that's what I thought was really interesting about the article. Is like, yes, it covers like that well-known case and it covers distress, but really it's an object lesson on how to pick the right syndicator, and almost like object lesson how to pick the wrong syndicator.
Yeah. And so it's fascinating. So I saw this piece and I read half of it, and then I had to go to a meeting, and I sent it to Matt. And I'm like, Matt, this is awesome. I was like, this is so interesting. I was like, I haven't seen, like a mainstream media piece kind of go into multifamily syndication, and it's going into this Houston portfolio. I didn't get to the piece though. There's a part of the article, and that I saw a familiar. I recognize the name,
Mm-hmm.
and I think as a disclosure, I would never talk about private conversations with an investor. But one of the individuals that was involved in this reached out to us around the same time that this all was being put together, and I had to go back into my email. And so I'm not going to get into specific details of who it was or anything, but more talking about a lesson learned of how to approach when you are looking for a sponsor, a general partner, an operator to invest in. Sorry, go ahead.
So this investor was looking at us at the same time that he was looking at Appleway Investment Group. And I'll tell you, I still feel a little regret that he did not end up investing with us. And I'm just going to make a couple of general statements before you can get into the specifics.
I disqualify. I at the end, I went to my email chain and I told that we wouldn't be a good fit to work.
Okay. Well, sure. and I do think, like, as an investor, if you're looking at multifamily syndicators, your return threshold and kind of almost the way you approach, like, politeness, if your return threshold is much higher than the industry averages, and most, if not all, of the syndicators that you're shopping around, if most of them are telling you that your targeted returns don't fit their risk profile, or maybe they find a polite way of saying that this won't work out well, then maybe you should start to rethink your approach. Because if you keep shopping around for someone to tell you what you want to hear, then that's the only people that are going to do it. Is that people are going to tell you and you're cutting yourself off from a crucial source of information if you're going to ignore all these other people that are saying, oh, this is too risky, this is too risky. That's exactly what I think happened.
Yeah, but this investor basically, he gave me his criteria, and he was asking for a level of return in a time period that was not only like unrealistic, but statistically like highly improbable without just like faking numbers.
Yeah.
And I tried to explain that, in the current market, this is the range of returns, and it was related to like cash on cash in the second quarter of ownership, and wanting to basically be in the double digit range.
Yeah,
and this is a time period that we could probably get anywhere between 5% and 8% like cash on cash return, because there's literally like there's a lease expiration schedule. You don't go into apartment community and tell everyone the rent has gone up. They have leases. The leases have to expire.
But you're still making income, right? You're still making some cash on cash.
Yeah. You're making income, but I'm saying you can't go from 0 to 60. There's a time period it takes to go to 0 to 60. And it's based on the rate of lease expirations and the ability to actually get those increases.
Yeah.
The market will only sustain so many increases. But like, let's say if 50% of the leases don't turn over for half the year, which makes sense, to obtain a 10% cash on cash, if I have to move, rent's 10%, I actually have to move everything 20% to get the 10 if only 50% are renewing.
Yeah.
Long story short, it's just physically impossible to achieve what he was asking for.
Yeah.
And I tried to explain how that really isn't going to happen. And he basically responded saying that, well, I'm only looking for, the best of the absolute best.
Yeah, you're not good enough.
You're the top 1% of 1%. And I was like, that, I think that's fine.
And
but you're going to put yourself, if you are going to work with someone who's just going to tell you that, you're taking on a lot of risk. Because again, it's so simple, but risk equals return. you ask for that high degree of risk. If someone's going to...
return, and risk equals return. Return equals risk. If you're asking for that return.
Exactly.
Yeah.
That's what I'm
rolling the dice.
You're rolling the dice. You're asking for trouble. And I tried to... I went through my emails recently. This is about a year and a half ago. Back in 2021. 2 years ago. A little more than 2 years ago. Oh, makes sense. 2 years ago.
There you go.
Loans are coming due. And I tried to warn... I tried to warn this investor, saying that if you're pursuing sponsors just based on, what kind of preferred return they have, and for just what that they'll tell you you'll get those returns. He's basically saying he wanted everyone to tell him to get a 30 IRR, and 10% cash on cash year one. Yeah. And I was like, we do great deals, but I'm going to be realistic. And I was like, I'm going to underwrite conservatively, and I try to give you upside. I'm not going to. I was like, I could show you those numbers, but they're not real. And I told him that. Yeah. And here's the other thing. All I wanted to do was get on call this guy or have a Zoom call, because we were just, it's like, this isn't making sense. We're like talking past each other. I'm trying to get on the same page. He wanted to see, they wanted to see all our bank records. Yeah. And all of this very detailed due diligence, which we're very transparent. But if we take the time to, I'm not just someone random off the street. I'm not just going to hand over my bank records. I'm not even hand over bank records, when we're, selling a property. Yeah. Unless they really want to, there has to be a really good reason. Yeah. And if I can't have a phone call with you, I'm certainly not going to hand you.
Let me get a picture of your fridge. I want to know what you ate this morning.
Yeah. Yeah. Like, can we shake hands first? Yeah. Yeah. And I was he was in Texas, and I was going down to Texas, or when I was talking to him, and I was like, let's meet. Yeah. Like, let's meet, because he was saying, I was like,
we're in the city.
Because I was like, let's hop on a Zoom. And he was like, I like face-to-face meetings. Yeah. I was like, I'm coming to Texas. Let's get together. I was like, I was like worried about this guy.
Yeah. Yeah. We were talking about him.
And I feel horrible that, according to the article, if he admits publicly to the Wall Street Journal, they've lost a lot of money. They lost a lot.
So, and this is my assumption here, but pretend this happens. What if we're not the only ones he did approach? And what if he did approach 9 different syndicators, maybe 5, whatever, and they all said, I got to be realistic. We can't hit 30 IRR. I got to be realistic. And he's like, no, you're not good enough. You're not good enough. You're not good enough. Until you finally get to the person that tells you, yeah, I can make it. Do you trust that person?
Yeah, exactly. And it was an analysis, paralysis by analysis. Yeah, looking for a unicorn. And he found the unicorn, and then figured out the unicorns don't actually exist. It's all make believe. It was a donkey with stuck to his head. But because he was basically making himself feel comfortable, being like, I'm doing so much due diligence. He was like, he's like, here, I'm going to send you 10 spreadsheets of.
But you're not learning it. He wasn't learning anything.
He said he was like, I've searched 360,000 Form Ds filed. And I'm going through everyone. I'm looking for the top percent of 1% of 1%. And I guess the rest is history, man.
Well, yeah.
It's a lot of lessons to learn. And would never single anybody out, except that
he is in the article.
He spoke publicly about the entire situation in the Wall Street Journal. And when I saw the name, I could not, because we've talked about this person a lot as just like the wrong way to approach having discussions with a potential sponsor.
And that was my initial impression too. It's like, there's a lot of things when in our sales process, or even if we're working with like a broker or anything, there's like a politeness, and you think it's just being nice, or like, oh yeah, you just want to be a cool guy. People want to work with people that want to hang out, but like there is a specific logic to like the ethics and like
the relationship building. That's not just to make you feel good. There is a reason you want to understand people, what their motivations are, what their morals are. Are we on the same page? And the process that this investor took was to remove the relationship.
Yeah. And can you hit that number or not?
And make it to be 100% transactional. Yeah. Yeah. And while sure, at the end of the day, it comes down to returns in dollars, a cents to agree, but that's not everything still. Yeah. And it's, who do you want to do business with? Who do you trust? And who's going to do the right thing? And who's just in it to get, the quick fee, to get in and get out. Yeah. And that's the type of person who will just pull a number out of thin air. Because because people, while they're saying that they're doing so much due diligence and being so thorough, that greed kicks in. And I've seen it so many times where investors will just flood to the high returns, the projected returns, and will ignore everything because they see a number that looks very attractive to them. And they literally, nothing else matters. It's just that number on the page.
Yep. And that's probably why that Zillow computer couldn't do it. There is some nuance and some relationships that just can't yet be captured.
No, as much as we want to make real estate super efficient, it will never be.
2 more months and AI will have it, but for now.
Yeah, for now.
Moving away kind of from that digression, which I really still think this article provides so many useful clues. It's like there is a second article underneath this article, and it really is how an investor should kind of go about picking a syndicator. And one of the things that they're not so subtle critique, I think that they don't have a whole lot of great things to say about the lack of reporting requirements for multifamily apartment syndicators. And they say, quote, unlike public companies, syndicators in many cases aren't required to give regular updates on their buildings' financial performances. She said, and then as limited partners, investors have no say over spending. Some who lost their investment never knew the properties were in trouble until they were near foreclosure. Spencer, we're a private syndicator.
Yeah.
We agonize over creating better and better reports for our investors. And now I learned we don't even have to do this. We're not even required. What are we, for all this time, we could have just taken investors' money and then just ghosted them for all intents. I don't. So why do we do it? Are you saying that just because something isn't required by law doesn't mean that it's not the industry standard? Or I'm just having a little disconnect here. But really,
we're confusing regulations with what the right thing to do is, and how markets work, and really public and private markets, where public markets there is reporting requirements that have to be done on regular intervals. But private investments, syndications, again, it's all private. So it's all about what you and I, Matt, we can agree, we can come into an agreement on just about everything as long as it's actually legal. Now we butt up against, the SEC, we have to file for SEC exemptions. There are still laws obviously that apply. There's rules and regulations, but it's not the same extent as a publicly traded security, specifically requirements to report back to investors. So in the way that it used to be done, especially before 2012, it was maybe on a quarterly basis. You might get some envelope in the mail, not on a regular quarterly basis. Maybe it was around a quarter, maybe you'd get a check and no report. Maybe you'd get a financial statement with no, it was very minimal. And obviously that's been improved upon over and over and over versus a publicly traded company where you have to report absolutely everything.
Well, and here's another thing. There's more players in the market. Well, there's more demand. People want to stand out. How do you stand out?
It's a great example of, just market forces improving the industry and self-regulation because, one, I'm an LP investor. I've been an LP investor. I understand the importance of good reporting and the difference between a good report and a bad report. I also know what that does, the impression that leaves to an investor, and just how important communicating is with the good, bad, or the ugly. But it's easier for the syndicator in the long run to keep you informed throughout the process, so there's no big surprises. So it's always going to ebb and flow. But if we're in the loop, it's not what they describe.
Oh, you're talking
is that what happened in Houston is that everyone thought everything was going fine until everything. They foreclosed.
Yeah, and you're talking on a practical reason, that's how you run a good business.
I think
but I think for a marketing thing, I want people to pick us because we do great reports.
Well, so that there's that part of it also is it's it's a point for us to brag on. It's we do the best reports, and literally because we do it all, we look for ways to improve every single time. It's how can we make this report better?
You can ask Griffin and Blake.
We're gonna redo it, but one from a standpoint of how do we get more best information that an investor needs to see to have a good picture of what's going on. A way that's efficient for our teams to do it, so we're not having to do a bunch of data entry and manual work. So to automate it as much as possible, but also to be able to have the human element involved, so we can actually, it's not just a auto-generated report with no color. We want to be able to fill in between the lines in an efficient way. But that's because that's the vision of how we want it to be done. It's a way to stand out to investors, and I think it's easier on us and others. And we're not the only one that does it. There's a lot, and that's the same. It's
so that's another thing.
There's a lot of great investors. There's definitely people who are they're well intentioned. They just don't have the experience. Go ahead.
Yeah, just to put like an end on this, or it's like
it's important, so I don't mind going into it. Go ahead.
The angle of this Wall Street Journal article, there was like, I think what gave it away, their little critique, is they were making the connection between Apple's way.
Yeah, it doesn't matter.
Well,
syndicator
between the troubled syndicator and you hop, skip, and a jump, and you get to Grant Cardone.
Well, so
now there's nothing against Grant Cardone, but he's very much style, and like he's very, very self-promotional, very promotional, and they're talking about like these like very vocal people, and it's not like they're not connoting like a business like atmosphere to professional. It's almost like this hustle culture that they're trying to.
So we've talked about, Matt, the overlap and the correlation between kind of the personal development industry, the courses industry, and the multifamily industry. And the reason why there's such a big bridge is that, again, the barrier to entry to just get into multifamily syndication, like it is true. If you educate yourself, you put the team together. If you're, halfway intelligent, you can probably put a deal together if you work hard and and you have the path to do it. Like that is something that you can come out of any, background and do. And so for someone that's talking about, again, not the self-help, but personal development, it's like, hey, you want to make your life better. You want more money. You want to be able to do all these things, live the life that you want, which is all of it. Hey, how do I do that? Because I'm working at this job. It's not going to get me there. Yeah. They have to have some path. They have to have some idea to sell you on. And multifamily, because it works. Now, is everyone going to do it? Well, they don't care because you've paid your, whatever $15,000 admission ticket to their boot camp. I don't need everyone to succeed. I only need a couple of these people to actually get through and do well. Yeah. And it is true. If you put the time in, you keep doing it, like it's an incredible opportunity if you do it the right way. But the whole thing is, you have to build a team of the experts around you. Yeah, of what you don't know. Yeah,
and the suggestion is, at least if you read this, is like, oh, you're gonna see a lot of people that are all flashy telling you to invest in multifamily,
and they're all saying they have experience, and they're not necessarily experienced.
Swim at your own risk.
And so it's not. And so I'm glad you brought up the Grant Cardone, but again, it's all mentioned in the piece. So I think it's worth us talking about today. It's Grant Cardone is a common denominator in a lot of these cases. Then it goes to Brad Sumrock, which is also very well known. He's in the articles, we can talk about it. He's very well known, again, multifamily kind of coach and motivational speaker. He's done a ton of deals, and he does deals with his students. And I have nothing necessarily bad. I have nothing bad to say about Brad.
But they both have a genre. They both have the similar voice of this like hustle. It's possible if you just do it, but you never know who's right and who's wrong if you don't ask the right questions.
And there's a big difference between, now, if you invest in a deal with Grant Cardone, like
he can do it.
Well, he's got the teams together to do it now. Like,
but someone who sounds just like him,
buying good deals. I don't know. I don't know if he's buying good deals, but like, he probably has the team together to do the thing. And Brad Sumrock, same. I'm assuming has the team. And I believe that he has the experience. But the guys then are a couple tiers below him.
That look and sound just like him.
Just like him, that I even include him as a mentor, and he's on the bottom of their websites, like he's involved. Maybe maybe that new syndicator, and everyone has to start somewhere, right? Maybe that person, is completely above board, and they have a great business sense, and they've got a great background, and they can do great deals. And I know dozens and dozens of people that fit into that category. But then there's, I don't know how many out of 10. I don't know what the percentage is, but a percentage that either just don't have what it takes and who just get in too deep, or some that even have, just bad motivations or just poor business sense, and they're really unexperienced, and they take the taglines that Grant and Brad and whoever else are, feeding them, and it just creates a lot of just mediocre operators and mediocre deals. And who do you think has been buying all these deals with bridge loans? It's a lot of the syndicators, because they could get 80-85% loan to value. Didn't have to raise as much money because they didn't have the money to raise.
Yeah.
And they haven't been through the last cycle. They haven't been investing in real estate or apartments for years. And so they're just being told by these guys, it's all going to be fine. You just keep buying real estate and raise the money and then, move on. But they're not necessarily teaching courses in even how to operate the properties. They're telling you, teaching course on how to raise the capital and maybe put the deal together and network of brokers, but then what?
Yeah.
You got a 10-year business plan.
Just keep making more content
for 6 months. That's it.
Yeah.
Keep making content. So it's interesting. The good thing about all this, and how we are excited, Matt, is that, the cream should rise for the top.
Yeah.
And again, the reason why we do reporting, and maybe someone else that doesn't do reporting, I'd like to believe that we live in a universe where, the markets work somewhat.
Yeah, they'll reward it. I think
we should be rewarded, and the people who made bad decisions or just didn't have what it takes, unfortunately get taken out and move out of the way for the groups that not necessarily that are bigger or have been around longer, but who are just better.
Yeah.
And so...
Well, at the very least, though, from an investor perspective, here's a good example of what maybe you shouldn't do as when you're shopping around for syndicators, and maybe what you should ask for. Like, what are you reporting? What kind of reporting do you do? What are how much does your return profile match other similar syndicators? And just a little bit openness about your assumptions.
Well, and as the Wall Street Journal describes in the beginning of the piece, it's like there are some people who it's a part-time gig. Yeah. They're doing it, outside of business hours. There's some people who are, co-GPing with 10 people. Yeah. And it's like, it's not even their deal. Whose deal even is it? There's so many cooks in the kitchen. There's people who are, they just quit their job and it's just them. And, one other person. I mean, I was certainly in that boat for a while, just Alex and I doing it for, I was building teams and eventually built a much larger team. Yeah. And then there's groups that have, I think like us, that have moved beyond that and have grown and to have full-on operations. And I think that's the way that they describe it in the piece. But so it's not all, just investing in multifamily, it's not all the same. And we've talked about not just different, sponsors, man, and we'll move on because I know we've talked about this for a while, but I think it's important. You don't want to just lump everything together. Yeah. Talked about different sponsors, but also different risk profiles and hold periods and strategies. Where some people lump all apartment investing in as the same, but like we've talked about, doing a deal on a short-term loan that with a 2 to 3 year horizon is a completely different risk profile. Doing a deal with a 5 to 10 year horizon. Yeah. It's just different. It's different strokes for different folks. But the sad thing is the people who got in, they like the idea of investing in real estate. I know they had somewhat of a long-term vision in mind, but then got caught up in like, well, hey, here's a real estate deal. We're going to do it. And we're going to raise rents. We're going to make a bunch of money. We're going to 2x your money in 2 years. Like, okay, that sounds good. Yeah. Maybe we'll refinance. We'll hold on for the long term, but we're going to cash you out. Oh, that sounds great. I'm so excited. Yeah. Yeah. And then bam, zero. It's worth nothing. Yeah.